Welcome back to my channel, everyone. Happy Monday. As you've read from the title of this video, this is Macro Mondays, and this is episode 1. What I'm going to be doing with Macro Mondays, I'm going to be covering the top key themes and events every single Monday to the best of my ability, and I'm going to be sharing live trade examples of scenarios that I favor. More importantly, you can be able to jump on the back of those with me. Macro Mondays are proudly sponsored by, and I've partnered up with Black Bull Markets. Black Bull Markets are a New Zealand-based ECN broker backed by Tier 1 banks to provide deep liquidity. The reason I love Black Bull Markets so much is that you can connect your account straight through TradingView and trade directly on TradingView, so you don't have to worry about any issues with MT4, MT5 servers. You go ahead and trade straight through Black Bull Markets. If you click anywhere at the bottom in the description or anywhere around this video, you're going to go ahead and be able to open up an account with Black Bull Markets. No minimum deposit. They're fully regulated. You can go ahead and start today. So click the link down below, anywhere around this video. You can go ahead and get started. But without further ado, Macro Mondays, let's jump straight into the video. Two things ringing my bells and fully on my radar is the fact that one, China has had this complete slowdown. That is also known as a bottleneck in the macro environment, where you have this rapid growth and there isn't enough demand to sustain that growth, and you really have that decline thereafter. If something rises very quickly, do expect it to fall even quicker. And seeing as China is a net exporting country, it does rely on global growth to sustain those levels of output. The fact that we have had that slowdown in China is a canary in the coal mine for global growth, and we are going to start to see that filter through into the likes of Europe. We know Germany is extremely on the back foot right now. I'm expecting that canary in the coal mine to start affecting the ECB. So expecting ECB pause very, very soon. And the second point and the second thing that's really ringing on my radar is the fact that the Fed have paused. Inflation is really cooling in the US drastically, and we can see that in the likes of the dollar. Dollar right now, as you can see on your screen right now, really cracking lower. This was off the back of Friday's non-farm payroll really cooling. In 15 months, this was the biggest drop in expectations in US labor, in the labor market. We know the labor market has been an extremely stronghold and a point of reflection for the Fed. The fact that the Fed constantly refer to the strong labor market as a reason for them to continue tightening and to keep rates where it is, if we are slowly but surely starting to see canary in the coal mine with China, and we are starting to see that slowdown in growth, are we going to start to see that slowdown in demand in the US labor market? However, labor in the US remains extremely firm. So you've got points for both sides of the fence there. So I'm going to run through what I favor, and we're going to go from there. So dollar approaching a good level of support around 102. This for me is a very key technical level. Looking at that on the daily time frame, we know previously, dating back to March and April, 102 was a valid level of support. We understand that we do have an extremely hawkish Fed with a dot plot released several weeks ago showing no interest rate cuts for the rest of 2023 and one interest rate cut for the rest of 2024. So that dot plot, if anyone doesn't know what a dot plot is, the dot plot is literally each Fed member putting a dot on a piece of paper with the years and the interest rate on an axis of where they see rates going forward. This is market expectations, and we do understand that market expectations drives price. It's not per se what's happening now, but it's more importantly what is going to happen. The biggest thing driving markets this week is going to be the fact that US inflation is expected on Wednesday to cool massively back down to the 3% handle. In case you'd like to make a note, the Federal Reserve abide by a dual mandate scenario. A dual mandate is simply their job. Their job entails price stability, which is inflation, and maximum employment. The fact that we have inflation cooling well on its way to 2%, is it transitory? Is that narrative coming back? As well as the fact that we do have the US labor market showing signs of weakness. Is the Fed going to pause? Are there going to be further rate hikes? No one knows. Right, it's purely data dependent. So what I'll be doing is I'll be monitoring dollar around the 102 handle to go ahead and then dictate whether or not I'll be selling euro dollar. Euro dollar has been good to us over the past few weeks as we have traded these impulsive legs to the downside. However, given this sell-off in dollar, we are having this relief rally in the euro. So looking at euro right now, we can see on the daily time frame we do have this cup and handle pattern. If you don't know what that is a technical analysis pattern where you have this impulsive leg in the market. You have a small correction before that continuation. I'll put an image somewhere along this video right now. The fact that we are approaching a round psychological handle of 110 for me is a valid area to go ahead and play both scenarios. If China is a canary in the coal mine, and I am expecting that slowdown in the eurozone, we could have a weak euro, which could be played in many other relative value pairs, the likes of euro yen, euro Aussie, which we can get to later, or possibly even into next week if it's not ready yet. Second, you obviously got euro dollar, but that is purely dollar dependent, as majority of euro USD as a basket or as a pair is predominantly the inverse of the DXY of the dollar. So looking at dollar, my bias on euro is dollar dependent, right? If I want to go ahead and match an ECB expectation, I may have a higher probability matching that up in a different relative value pair. But for now, dollar selling off drastically, as we can see. Just really hopping on investing.com for a second, we can see this week on Wednesday, we do have the US CPI. Year over year expected to cool drastically to 3.1%. We know this is a key Fed metric, core inflation as well, and core PCE, which does show us consumer expenditure and so forth. But that's coming out later this month. We can see the headline figure now expected at 3.1%. So inflation is drastically cooling. If you want to go ahead and click on that shortly, we'll just run through how inflation hit 40-year highs. It last traded back up at these highs in the 1980s. So several months ago, there was a transitory inflation narrative where several Fed members, as well as several central bank officials, expected inflation to be transitory, meaning it wasn't going to be up there for very long. I think they were right. I just think they were slightly early on projecting that narrative. So looking at that right now, we hit the highs of 9.1 on CPI. But then we also cooling drastically. Month over month, we're missing expectations. Why? Canary in the coal mine, China. Inflation is the cost of goods and services, but if you are having this decrease in demand, you're naturally going to have that suppression in prices, which should ramp up demand, ramp up consumer confidence, but it is a slow burner. It is a slow process. So looking at inflation right now, should we come anywhere in line with expectations, we could have that sell-off, a further sell-off in dollar, and another attempt at the 102 lows, which we are fast approaching right now. This has elevated risk across markets. You can see the Dow up 0.4% on the day, gold floating in and around the 1925 handle. In terms of trading the China scenario, do expect commodities to be on the back foot. We have seen gold trade and trend to the downside over the past few months as that demand starts to diminish, right? We can see that in the likes of oil as well. Oil has been trading within a range from $67.50 to $73, so about $5-6 per barrel on that over there. We have seen OPEC fight back several times, ramping up demand by cutting a daily output. If you cut daily output, you're naturally going to have that ramp up in demand, which does stimulate the price of oil. Me looking forward, me looking ahead, I am still bearish oil, and I would like to sell the rallies. Where would I like to sell the rallies from? I would like to sell the rally anywhere into 76, 77.50 per barrel on oil, because I am playing that China narrative, and I am looking at that global slowdown. That global demand for oil will diminish, and hence the price of oil cooling drastically. We did have the Russian invasion highs up there at around $130 a barrel, but if I really have to look forward, I do see us trading at $60 a barrel before year end. But folks, I'm not going to give you all the nuggets right now. Make sure you tune in again next week, Monday, for Macro Mondays episode 2. Don't forget to go ahead and sign up to Black Bull Markets, the partner and the sponsor of this video. You can go ahead and start today. No minimum deposit required. They are a regulated broker. They are Kiwi based. and they also are backed by tier 1 banks to provide no issues with liquidity whatsoever. If you want to go ahead and use them to deposit with cryptocurrency, feel free. They do have that option. Other than that, please note everything I've mentioned in this video is not financial advice. It should be taken for educational purposes only, and go ahead and map that out on your own charts and watch the markets unfold in real time. But I hope you enjoyed this video. Do like and comment, share, subscribe the video. Go ahead and drop in the comments below what you want me to cover on episode 2, and I'll do that for you. Look forward to seeing you in the next video. Take care. Bye-bye.